Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Advanced Energy Industries, Inc. Annual Report. Advanced Energy Industries, Inc. offers a diverse range of products and services to various industries worldwide. The company's precision power conversion, measurement, and control solutions cater to the needs of semiconductor and thin film plasma processes, including dry etch and deposition. In addition to its plasma power products, Advanced Energy provides high and low voltage power products for applications such as industrial production, medical equipment, data centers, computing, networking, and telecommunications. The company's sensing, controls, and instrumentation products enable advanced measurement and calibration of power and temperature. The company also offers a range of services including calibration, conversions, upgrades, and refurbishments of used equipment, as well as repair and maintenance services. Furthermore, Advanced Energy provides warranty and non-warranty repair services to its customers through various channels such as direct sales force, independent sales representatives, channel partners, and distributors. The stock price of Advanced Energy Industries, Inc. (AEIS) has skyrocketed by over 150% in the past year due to a combination of strong financial performance, robust demand in key markets, and positive analyst sentiment. The company's exceptional fourth quarter and full year 2025 financial results exceeded expectations, with revenue growing 21% to $1.8 billion and non-GAAP EPS increasing by 73%. This was driven by booming demand from hyperscalers adopting AEIS power solutions for AI rack applications in the data center computing market. The company's solid semiconductor market performance also contributed significantly, with revenue increasing 6% year-over-year in 2025. The introduction of new products such as eVo-S and eVerest is expected to accelerate this growth. Additionally, Advanced Energy Industries demonstrated improved profitability, with non-GAAP operating margin expanding to 17.8% in Q4 2025, its best performance in 5 years. The company's optimistic outlook for high teens total revenue growth in 2026, coupled with the strong data center outlook, fueled positive investor sentiment. Several analysts responded by raising their price targets and maintaining buy or overweight ratings, indicating strong confidence in the company's future performance. As a result, Advanced Energy Industries, Inc. has become one of the top performers in the market, with its stock price continuing to rise due to its robust financials, expanding margins, and record cash flow. Advanced Energy Industries, Inc. market capitalization of $12 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Advanced Energy Industries, Inc. holds a significant advantage in their industry. Advanced Energy Industries, Inc. trades at a higher price-to-earnings ratio of 81 times and a higher price-to-book ratio of 8.67 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline are multifaceted and influenced by various market and business factors. Revenue growth is primarily driven by the rapid expansion of the data center computing market, fueled by investments in artificial intelligence, AI, and related technologies. The semiconductor equipment market also experiences significant growth due to increased demand for leading-edge process tools. Additionally, successful integration of acquired businesses and manufacturing cost improvement programs contribute to revenue growth. Furthermore, design wins with existing and new customers play a crucial role in driving revenue expansion. On the other hand, revenue decline is often attributed to customer price sensitivity and pressure to reduce prices, as well as loss or decline in revenue from large customers due to inability to collect payments. The mix of products sold to customers also affects revenue, particularly when lower-margin products dominate the market. Disruptions in global economy or financial markets can further exacerbate revenue decline. Net income and profit margins experienced significant fluctuations over the period under review. Initially, net income decreased due to various factors such as market volatility, decreased demand, increased competition, and regulatory risks. However, this trend reversed with a notable increase of $148.1 million, 28%, from $529.3 million to $677.4 million in 2025. Profit margins also faced challenges, declining due to reduced revenue, high inventory levels, and production overcapacity. Additionally, decreased gross profit from increased warranty, claim activity, and servicing costs negatively impacted profit margins. However, the introduction of a manufacturing cost improvement program led to an increase in gross margin, contributing to improved net income. The trend continued with a significant increase in net income, rising by 164.5% from $56.3 million to $149.3 million in 2025. This growth was accompanied by improvements in profit margins, including a 2 percentage point increase in gross profit margin and a 6.8 percentage point improvement in operating income from continuing operations margin. The overall picture suggests that net income and profit margins have shown significant improvement over the period under review. The factors contributing to this growth include manufacturing cost improvements, higher revenue, and strategic initiatives aimed at enhancing competitiveness and reducing costs. The company's financial performance indicates a positive trend in operating cash flow. According to the provided information, the net cash from operating activities for the year ended December 31, 2025 is $233.3 million. This suggests that the company has been able to generate sufficient cash from its core operations to meet its financial obligations. A closer look at the data reveals a consistent pattern of positive operating cash flow over the past 3 years. Although there was a brief setback in 2024, the company's ability to bounce back and achieve positive cash flow in both 2023 and 2025 is a testament to its financial resilience. This trend bodes well for the company's future prospects and suggests that it has a solid foundation for long-term growth and sustainability. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the debt level has increased significantly in 2025 compared to 2024. The current portion of long-term debt increased from $0 million in 2024 to $567.5 million in 2025, while total current liabilities also rose from $314.3 million to $991.2 million. The net long-term debt increased by approximately $2.8 million, from $564.7 million in 2024 to $567.5 million in 2025. Additionally, the company's overall debt level rose from $624.6 million at the end of 2024 to $951.1 million at the end of 2025. In terms of interest expenses, there has been a significant decrease in 2025 compared to 2024. The interest expense related to debt decreased by approximately $8.5 million, from $25.2 million in 2024 to $16.7 million in 2025. Furthermore, the reclassification of interest expenses changed from $6.3 million in 2024 to -$2.9 million in 2025. Overall, these changes indicate that the company's debt level has increased significantly, while its interest expenses have decreased substantially over the past year. Management's outlook on company strategy. The company's management has expressed a cautious outlook due to various risks and uncertainties. Despite this, they are optimistic about the growth prospects driven by increasing demand in key markets such as data center computing and semiconductor equipment. The revenue has seen a significant increase of 21.4% in 2025, primarily fueled by growth in these markets. management is investing heavily in manufacturing footprint and capacity, new ERP system, and other capabilities across multiple sites to support the company's growth strategy. They are also consolidating research and development, sales, and administrative functions, which is expected to be substantially complete by 2027. Additionally, they are managing foreign currency exchange risks through the use of derivative financial instruments. The management expects improving conditions in the semiconductor equipment market to continue into 2026, providing a positive outlook for the company's growth prospects. However, they are also considering the impact of tax holidays and potential changes to global minimum tax rates on the company's financial position. Overall, management is taking proactive steps to mitigate risks while investing in strategic initiatives to drive growth and improve the company's competitive position. The company has undergone significant changes through acquisitions and divestitures. Notably, there have been no acquisitions mentioned throughout the report. On the other hand, the company has made several divestiture decisions. One notable divestiture was the discontinuation of legacy inverter products in December 2015. This decision marked a strategic shift away from certain product lines, allowing the company to focus on more modern and innovative offerings. Additionally, the manufacturing operations in Zhongshan ceased during the second quarter of 2022, further demonstrating the company's efforts to streamline its operations and optimize its resources. These divestitures reflect the company's commitment to adapting to changing market conditions and prioritizing growth through strategic decision-making. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to shareholders. As per the records, the company has indeed paid dividends on multiple occasions, with specific references found on pages 30, 31, and 43. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares from the market, potentially boosting shareholder value. The records indicate that the company has bought back shares on pages 24, 30, and 43. Demonstrating a commitment to returning value to shareholders through both dividend payments and share repurchases. Concerns about inventory buildup and supply chain disruption are prevalent throughout the provided summary. On page 11, high inventory levels can lead to price erosion and revenue decline. Pages 12-13 highlight potential inventory buildup due to overpurchasing, uncertain economic conditions, customer liquidity constraints, and difficulties in obtaining critical components. Supply chain disruptions are also a concern, as seen on pages 15, 18, and 32. Natural disasters, uncontrollable events, interruptions to supply chains, delays or restrictions on shipping materials or finished products, and unfavorable currency exchange rate fluctuations can all impact operations and supply chain. Additionally, trade tensions between the U.S. and China, page 19, and tariffs affecting II announced by the U.S. government, page 32. Have had a material adverse effect on operations and supply chain. The data also shows an increase in inventory levels from $51.8 million from 2024 to 2025, with parts and raw materials inventory increasing by $58.5 million, while finished goods inventory decreased by $14.4 million, page 72. This suggests that the company is struggling to manage its inventory effectively, which can lead to further concerns about supply chain disruptions. Overall, the repeated concerns about inventory buildup and supply chain disruption across multiple pages indicate a significant risk for the company's operations and financial performance. That concludes the financial summary for Advanced Energy Industries Inc. Feel free to comment below, and I will be happy to answer them when possible.